Welcome everyone to FX Street. It is 8 a.m. Eastern. Today is Friday, July 27th, 2012. Welcome back one and all. Great you could join us. My name is Adam Rosen. Very happy that you could be here today. In 30 minutes from now, 8:30 a.m. Eastern, U.S. GDP gross domestic product figures will be released. This is a very big number, probably one of the biggest numbers that we've seen in a while, and probably one of the biggest ones we'll see for quite some time. Gross domestic product is one of the three big numbers that the Fed uses in their projections to make their decision whether to raise or lower interest rates, as well as to give us any further rounds of stimulus. Now, to go back a little bit, here we have a chart, actually. This is an FX Street article that we put together not too far back. I'll send you the link as well. Okay. Let me know if you can't see that, by the way. Okay, so the red line represents U.S. GDP, gross domestic product. The blue lines represent the Fed's projections, the upper and lower range of the Fed's projection. The Fed projects that U.S. GDP will fall. I can double check the Fed's actual figures, roughly between the 1.9 to 2% level. And in fact, I'll give you the exact figures. We can look at actually the Fed website itself. This is the Federal Reserve website, including their projections for GDP, which they now project for the year 2012 to be between 1.9 to 2.4%. That is what the Fed projected GDP should be in. Now, the reason why this is important is because, again, if GDP comes in higher than expected, it means that we're a little bit more likely to see higher interest rates, less likely to see stimulus, like quantitative easing 3. If GDP falls below estimates, we're less likely to see higher interest rates and more likely to see quantitative easing 3. What would be the impact of higher, lower interest rates and more stimulus or not more stimulus? Well, we've spent quite a bit of time over the past few months analyzing the correlations, and that over time, obviously we know that as interest rates rise, we tend to see a stronger dollar. As interest rates rise, that also puts a strain on equity markets in the short term. You see, over the long term, as the U.S. economy recovers, we expect GDP to rise, and we'd expect to see that growth reflected in higher stock prices. But in the short term, if the Federal Reserve is projected to raise interest rates, then we might expect to see a little bit of lower stock prices. Conversely, we look at a very aggressive type of stimulus called quantitative easing. We've had quantitative easing 1 and quantitative easing 2. The yellow shaded area on the left side of this chart represents a period of time with quantitative easing 2. Not the whole time, just the end. We can see how the Federal Reserve projections came down as GDP started to move to the upside. But what's really very amazing is that notice how far above, how much the Federal Reserve missed on their projections. They projected GDP to fall between 3.5 to almost 4% level, whereas U.S. GDP at the time was only 1 to 1.5%. Now, the last meeting in June, the Federal Reserve was, number one, they were expected to keep interest rates unchanged at 0. That remained steady. That remained consistent. Number two, the Federal Reserve was expected to conclude its last round of stimulus, which is known as Operation Twist. Operation Twist simply, they sell the short-term maturity bonds in their portfolio and use that capital to buy long-term maturity bonds. That's done to keep long-term interest rates low. That's why 30-year mortgages and long-term interest rates are as low as they are, because of all the bond purchases. That was expected to end in June. Well, the Federal Reserve met was on June 19th and 20th, I believe. They extended Operation Twist to the end of the year. Now, as Operation Twist is extended through the end of the year, that means more bond purchases, which in turn is deemed to stimulate the economy. The question now is, and we know that the projections for GDP are, what do we say, anywhere from 1.9 to 2.4%, and the last GDP figure was actually 1.9%. That was 2 months in a row. We had 1.9% estimates for U.S. GDP. The question is now, where will GDP fall? If it comes in far below the estimates, the estimate range is, I believe, 1.9 to 2.4%. If we get estimates much, much below the projections, where the Federal Reserve, this is where the Federal Reserve projects GDP should be reported. If we come in much lower, well, that means lower interest rates for a longer period of time. And more importantly, that builds the case for quantitative easing. And over the past couple of weeks, Ben Bernanke testified in front of the Senate. It's called the Beige Book, which is a quarterly report, I should say, that gives us a very insightful look into what the Federal Reserve anticipates for the rest of the year, or for the next quarter at least. And the Federal Reserve sent a very strong message saying that there is more stimulus on the books, meaning quantitative easing 3. They could initiate another round of quantitative easing 3. Now, we talked about Operation Twist. The difference between Operation Twist and quantitative easing, very simply, is that, again, Operation Twist, we sell short-term bonds, and we use that capital to buy long-term bonds inside the Treasury. The difference is quantitative easing prints new money. Out of nowhere, out of thin air, they create new money, and they use that new money to buy long-term bonds. So the effect is the same. We're buying long-term bonds. The difference is, in Twist, we're selling short-term maturity bonds. In quantitative easing, we're printing new money. There are unintended consequences of quantitative easing. Quantitative easing, for example, and we're going to keep an eye on the economic calendar here. In quantitative easing, because we're printing new money, there's more dollars in circulation. As there's more dollars in circulation, each dollar has a little bit less buying power, and that forces commodity prices higher. That forces almost all prices higher, because every one of our dollars has more dollars to compete with to buy the same goods and services in the free market, in the open market. So the price of oil goes up, the price of gold goes up, the price of a lot of commodities, food especially, goes up. Food's a very important issue, by the way. Now, the Federal Reserve was really criticized, especially at the end of quantitative easing too. And you remember what oil prices were going back to April, May of this year, in the midst of quantitative easing too. That was a direct result. Those high oil prices were a direct result of quantitative easing. And, you know, the people complained to their congressman, and congressman complained to Bernanke. He said, hey, they told Bernanke, Ben Bernanke, Federal Reserve Chairman, stop quantitative easing. You're sending commodity prices up too much. Food and oil, or food and fuel, I should say, which, by the way, are the core measures of inflation, or I should say, let me say it this way. When we talk about inflation and core inflation excludes food and energy because they're considered more volatile components. Think of inflation, the most sensitive component of inflation is food and fuel. That's most directly affected by quantitative easing. Now, again, the American public complained to Congress. Congress complained to Bernanke. Bernanke said, okay, well, no more quantitative easing because food is too expensive and fuel is too expensive. So we came along with Operation Twist, which is what we see now. The problem is Operation Twist is not as effective as quantitative easing 3. And it's really quite remarkable how much of a short-term memory everyone has. Because during the Beige Book testimony, that's where Chairman Ben Bernanke testified in front of the Senate and the congressmen and everyone, you know, they asked him these questions about where do you think the economy is going to be and what can be done. One of the most popular questions during these proceedings was that why do we not have more quantitative easing? And such a short-term memory the Congress has that not too long ago, they're the same individuals who scolded Ben Bernanke for too much quantitative easing that caused high oil prices and high food prices. But now, because congressmen are worried about an election and, you know, worried about their public poll numbers, they want the economy to do well. They want the stock market to go up. They want the jobs numbers to go, the unemployment number to go down. We want 500,000 on non-farm payroll numbers, really good numbers. So the congressmen want the economy to recover. What's a really good way to give the economy a shot in the arm? Quantitative easing. Brings us back, it's all one big circle, brings us back to the beginning. Are we going to get more QE, quantitative easing? The answer, in part, may reveal itself in the next 22 minutes. If U.S. GDP is far below the projections of 1.9 to 2.4%, that is going to give the Federal Reserve a really good excuse for more quantitative easing. Now, people may complain. They may say, well, quantitative easing sends the price of oil up too much, and quantitative easing sends the price of food up too much. Well, the Chairman Ben Bernanke can say, listen, I understand that. However, the economy overall really needs it. And, the benefits outweigh the risks. If GDP comes in line to 1.9% or maybe within the range or, somewhere close to where we project it to be, the Federal Reserve has less of an excuse to initiate more QE. I hear Ben Bernanke will probably do more QE than twist if there is a next time. That really, it's really the whole question that everyone's trying to answer here is that, are we going to get more QE? Now, quantitative easing ultimately is very good for stocks because imagine that we have, X amount of businesses in the U.S. and every business we sell our goods and we sell a certain amount of goods and services. We sell our widgets and, everything else. If there's more dollars in circulation in the economy, each individual has more money, or there's just simply more customers. More customers, more people shopping, we're selling more goods and services, corporate earnings go up, Apple Computer sells more iPhones, we all make money, stock market goes up. Stock market loves quantitative easing. Not as much Operation Twist. Quantitative easing is a lot more aggressive. Now, stock market likes this, but the problem is, as the stock market goes up, well, it's not a problem, but the other consequence is that the dollar usually goes down. So if we're trying to anticipate a trade, let's say, for example, that GDP comes in far below estimates, 1.2%, really a horrible number. Well, that builds a really good case for more QE. I think that in a sense, if the stock market sees a tricky situation, how much bad news is bad enough where the stock market automatically says, okay, that means we're getting more QE. If GDP is 1.8%, 1.9%, not good but not horrible, maybe stocks go down. Maybe the dollar, I don't know what the dollar would do. But if the number is really, really bad, the stock market could actually really like this number because the stock market could say, great, this is bad news. And bad news is great because every time we get bad news, we get more quantitative easing. The Federal Reserve has become so reactionary, and I don't remember this ever being like this in the past. The Federal Reserve has become so reactionary to the economic numbers that any bad piece of news, the stock market almost assumes, okay, that means we're getting more QE. All the economies around the world, the economies that are really in trouble, including us in Europe for the most part, have become very, very sensitive to possibilities of stimulus. Over the past month, I think probably since we last spoke, or maybe the past couple weeks, we've seen so many additional rounds of stimulus. We've had, if I recall correctly, we had what? The People's Bank of China lowered interest rates. Bank of India, I believe, lowered interest rates. Not last meeting, but the meeting prior, Reserve Bank of Australia lowered interest rates. Bank of England, quantitative easing of their own, and they really need it because we've seen negative GDP numbers for a couple months consecutive now. European Central Bank, for the first time ever, cut interest rates during the last meeting below 1% to 0.75%. Yesterday, take a look at we're looking at, we're not looking at this. Yesterday, take a look at the euro-dollar chart. We had one of the biggest candles to the upside euro-dollar seen in quite a long time. Why? European Central Bank, Mario Draghi, came out with a very simple statement around 4 or 5 a.m. Eastern yesterday. He said the European Central Bank is prepared to do whatever is needed to save the euro. And a lot of traders anticipate, a lot of analysts anticipate that involves, or that will involve, the purchase of Spanish debt, Spanish bonds. 10-year Spanish bond yield is down 2.89%. When you buy the bonds, the bond price goes up, the yield goes down. Bond yields were above 7.5% for the 10-year bond in Spain earlier this week. Now they are at 6.72%. These are huge moves. 0.75 of 1 percentage point, 75 basis point move in 24 hours in the Spanish bond market, or 36 hours, let's say. as a result of the anticipation of Spain buying more bonds. The markets and our economies have become addicted to stimulus. Now, I happen to think that this is not a very good course to go, but we've really kind of painted ourselves into a corner. The problem is this. Now that U.S. GDP right now is 1.9%, but it's not 1.9%. It's 1.9% with probably a 60% chance that we're going to get more quantitative easing. It's 1.9% with Operation Twist. Question to you is that where would GDP be right now if the Federal Reserve came out right now and they said, you know what, no more stimulus, we're cutting you off. No more quantitative easing, no more Operation Twist, no more cash for clunkers, we're not doing anything. We're just going to let the economy fix itself. Where would U.S. GDP be? I would argue probably negative. The U.S. GDP number, 1.9%, is 1.9% while the economy is on steroids, for lack of a better word, steroids being the stimulus measures. And it's a dangerous thing because in the old days, we used to have, 4 or 5% GDP, and I didn't know what quantitative easing was. 5% GDP, and, nobody knew. Operation Twist we had not seen since the 1960s. But now we have 1.9% GDP. Take a look at the calendar, by the way. Estimates for today, U.S. GDP. These are the estimates on the FX Street calendar. We've had 2 consecutive months of 1.9%. We're expecting 1.4% now. That's not good. And that's on Operation Twist. We had a NASDAQ bubble in the year 2000. The NASDAQ hit an all-time high of 5,132. I'll never forget that number. That was with no quantitative easing and no Operation Twist. We had a housing market in 2007 that hit all-time historic galactic highs, and there was no such thing as quantitative easing. Now we have Operation Twist that followed 2 rounds of quantitative easing. Operation Twist now extended to the end of the year. We've had low interest rates since 2008, 0%. We're probably going to have 0% interest rates until 2014. That's what most estimates say. Probably till the end of 2014. And we have a 60, I don't know what the exact number is. I'm guessing 60% chance of quantitative easing 3. And yet we have 1.9% GDP, and all the best minds in the world expect 1.4%. The market the economy has been retrained to expect low GDP. And that low GDP the market has also been trained to expect low GDP will come alongside the stimulus. Well, fast forward till today, we're expecting 1.4% GDP. Again, if it comes in much below estimates, we're much below the previous number. If it comes in line at 1.4%, there's really nothing to look to congratulate ourselves about. Maybe that puts QE back on the table. Maybe that's good for stocks. I've been a bear on stocks for a long time, and they keep on going up. But, you really can't fight the Fed. And the Fed continues to, supply the stock market with this really sugary water, meaning stimulus. And then more bad news means we get more stimulus. Take a look at some of our other economic numbers here. All right. Let's see here. And I'll give everyone the link. It's through FX Street. Okay. And specifically part 2, and I'll give everybody a link here. There we go. I lost the link. All right. Okay, so we know what the GDP number looked like. There are 3 components. Again, this is GDP. This is U.S. unemployment. There are 3 components that the Federal Reserve watches in their projections. And in the past, we never really had this. The Federal Reserve would meet. Alan Greenspan at the time, former Fed chairman, he would say, in a very difficult way to understand, he would say, well, the Federal Reserve is leaving rates unchanged. Retail sales are good. Our expectation for inflation and consumer spending, blah, blah, blah. And we are optimistically future, and we'll have to see what happens. And it was so ambiguous, nobody understood the statement, and nobody really knew what it meant. But I think that was kind of good because it left the market to make the decision on its own. The Federal Reserve was criticized again by Congress. Seems like all these problems start in Congress. The more they try to help us, the more they hurt us. The congressmen criticized the Federal Reserve saying, you're not transparent enough. The American people don't understand what you're saying. You need to tell us exactly what you're thinking. And you need to tell us exactly what you're going to do. Businesses won't hire unless they know we're getting more quantitative easing. Nobody's going to want to buy a house unless we get more Operation Twist. So the Federal Reserve said, okay, we understand. That's legitimate. We're going to start releasing projections every meeting. Every meeting, we're going to tell you exactly what we want to see. We want to see unemployment levels. The projection is 8.0 to 8.2%. That's where the U.S. unemployment rate should be by the end of 2012. If it comes in higher than that, well, that's bad. If it comes in lower, that's good. If it comes in lower for the unemployment level, then we're more likely to raise interest rates. If it comes in above, we're less likely to raise interest rates. Can't cut below zero, so you're probably going to get more stimulus, quantitative easing or twist, something of that nature. So the projections discuss three big numbers. GDP, which we're going to get in about 9 minutes. Unemployment, 8.2%, and inflation. Normally, when we say inflation, we think CPI, Consumer Price Index. The Federal Reserve uses something called PCE, Personal Consumption Expenditure. It's very similar to CPI. The only difference is it really allows for substitutions from one good and service to another, but that's neither here nor there. I have a conspiracy theory, though, about the Federal Reserve projections. Take a look to see what happened. Okay, this is Operation Twist. This is September, October, November of last year, January, February, March, all the way through June of this year, Operation Twist. Now, June of this year, June 19th and 20th, the Federal Reserve met. That's when they were expected to conclude Operation Twist. Now, remember, put yourself in the shoes of the Federal Reserve. Federal Reserve really, they're supposed to be independent, but, they're very closely influenced, I think, by Congress. And they want the economy to improve. They get really criticized a lot when the economy doesn't improve. They're not in charge of the economy. They just determine interest rates. But the Federal Reserve really wants the economy to improve. And they know that the economy has a better chance to improve if we get more stimulus. I happen to disagree, but in the short term, it feels that way. Well, how do the Federal Reserve is thinking to themselves, and this is my conspiracy theory, the Federal Reserve is thinking, how can we justify more quantitative easing? How can we justify more Operation Twist? Operation Twist is supposed to end in June. We told everybody it's going to end in June. How do we justify giving everybody more stimulus? We need bad news. Well, they can't manufacture the numbers, but what they can do is adjust the estimates. They can adjust the estimates to make whatever news we get look bad. It's like our children going to school, and as they walk out the door, they say, Mom and Dad, don't worry. I'm going to take a test today. I have a math test today, and I promise you I'm getting an A+. I will accept nothing less than 100%. Well, when they come home after taking the test and they get a 95% on the score on the test, although 95 is good, it's a disappointment from our projections. The Federal Reserve, notice the blue lines over here. U.S. unemployment rate was starting to decline to the downside, but they really brought down the projections right before the end of Operation Twist. In May of this year, April, May of this year, the Federal Reserve met. Their projections were ratcheted down a lot, down to a 7.8% unemployment level, 7.8 to, let's say, 8.2. Now, granted, the unemployment rate had been declining. I accept that. However, was it declining? So was the economy so good? Think back, April, May of this year. Was the economy in the U.S. so good 3 months ago, 2 months ago, that it justified in such a sensitive time to bring up projections down on the unemployment levels. Actually, we're expecting good things. Was the economy in such a good, healthy state that it was good enough, or strong enough for the Federal Reserve to say, you know what, we are so optimistic. Don't worry, we're going to shoot for the stars. We're going to get 100% on our test, and we're going to be okay. The crisis is over. Well, what happened? They brought the projections down so much that any unemployment level that we actually got was bad. That bad number, in turn, justified more quantitative easing, more stimulus. Take a look at the GDP number. The unemployment number doesn't necessarily do a good job of demonstrating this, but the GDP does. Okay, here's U.S. GDP. U.S. GDP, Operation Twist, the projections are coming down. Federal Reserve admitted, we really overprojected. We overestimated the strength of the economy. The GDP was down here. GDP starts to come to the upside. We hit levels of 3%. Now, 3% on this chart looks good. We should be a lot higher. In recovery, we expect the market to really expand. How many millions, 4 million jobs we lost in 2008 recession? We should be getting back a lot of those jobs. We're not, but we should be. We should be getting back those 4 million jobs. We should see in a recovery GDP of 6, 7, 8%, or at least, somewhere around those levels. I heard an analyst recently on TV talking about the U.S. GDP. I think it was in the recovery during Ronald Reagan's administration. Interest rates were sky high. The economy was definitely not firing on all cylinders. But that expansion gave us very, very high GDP numbers, because the GDP, either on a quarter-over-quarter or a year-over-year basis, measures the rate of change. And it shows us that the market is really starting to expand during that period of time. So GDP at 3%, I ask, why was it not at 5% or 7%? But even before the Federal Reserve raised the projections, and GDP started to come back down. Notice this blue line. This is the Federal Reserve promising us things are going to be okay. Don't worry about it. April, May of this year, I think the Federal Reserve kind of pulled a fast one over our eyes. Federal Reserve says we really want to, Congress is putting a lot of pressure on us to create more stimulus. We can't justify more stimulus from nowhere. We need a reason. Well, we need those GDP numbers to look really bad. And if the GDP numbers look really bad, then we have a case for more stimulus. This is what they did. They ratcheted up the projections. I mean, I was sitting here with all of you in the same economy, going to the same stores, making the same salary. I don't remember the economy March, April, May of this year really feeling that fantastic. We did, I think, have a little bit of an uptick. I mean, the numbers did tick up to the upside, especially in the housing market. But it was not a fantastic uptick. And my other point is that, okay, let's say the Federal Reserve legitimately really expected the economy to be back on track for a full recovery. What would be so bad for the markets, for the economy in terms of the perception, for GDP to beat expectations, to beat the projections, for the unemployment level? Let the Federal Reserve miss their projections, but miss in a more optimistic way. Meaning, let these numbers, let these economists on CNBC and Bloomberg TV come out and say, you know what? The Federal Reserve expected 1.9% GDP, and we got 3% GDP. Wow, things are great. Wouldn't that good news be better for this economy overall? Maybe even if the economy wasn't that good, it would compel people to get out there and start to buy houses and go shopping again, and that in turn could have a snowball effect and improve the economy. We'd like to see these people on TV talk in a positive way. By the way, U.S. GDP in less than 60 seconds from now. So here where we stand now, again, U.S. GDP, let's go to dollar Swissy chart, because I like to watch dollar Swissy with any U.S. number. Again, FX Street calendar projects GDP at 1.4%. Last month, it was 1.9%. U.S. GDP, 1.4%. Expectations, 1.9% previous. Actual 1.5%. What does this mean? 1.5%. Wow. Okay. So we're going to watch the dollar. Oh, you know what we're going to do? We're going to watch the dollar. We're also going to watch the stock market because I think these can both be very revealing. Here's the Dow Jones Industrial Average on the top. Here's the dollar Swissy currency pair on the bottom, both 5-minute charts. Dow futures are surging to the upside, and the dollar is upticking also, which doesn't make any sense at all because they usually move in a opposite direction. By the way, U.S. GDP, the last month's estimate, I should say, was 1.9%. It looks like they were revised last month up to 2.0%. Let me read off Dow Jones News Tape. U.S. GDP 1.5% rate in second quarter, consensus 1.3. That's the consensus. Final GDP first quarter revised to 2.0. So the revised previous figure up to 2.0%. I agree. I think it stinks. Real final sales at 1.2% second quarter. PCE price index 0.7% in second quarter. Core PCE up 1.8%. Domestic purchase price index 0.7%. We're going to have to look at the calendar to see what all this means. But the big headline numbers, obviously GDP. It's very curious why stocks and the dollar are going up because usually the opposite happens. Usually stocks go up when we expect more stimulus. Does this 1.5%, does this 1.5%, and bonds are going down, does this 1.5%, what does this tell us? That it's contradictory in my mind. I really don't get this. In my mind, GDP is released and stocks go up. That tells me more quantitative easing. But if GDP is released and the dollar goes up, it means no more quantitative easing because quantitative easing tends to dilute the dollar, tends to push the dollar down. And it means that we're probably going to get higher interest rates when I see the dollars going up. So the dollar going up tells me that this is good news. I think the dollar is going up, to be perfectly honest with you, because last month was revised up. 1.9% now became 2%. Stock market's going up. Well, maybe in anticipation that maybe it's not necessarily QE. Or maybe, you know what? I'll tell you something. I think what's happening is this. I think, and I haven't listened to anybody on TV yet. Obviously, we've been talking here. But I think the stock market is going up because it's saying, look, last month, GDP was revised up. This month, it's a little bit better than expectations, 1.5 versus 1.4 or 1.3. But we still think we're going to get quantitative easing. I mean, the economy has become, not the economy, the stock market has become so spoiled. It's like a spoiled child. Good news, we're going to get quantitative easing. Bad news, we're going to get quantitative easing. Whatever happens, we're going to get quantitative easing. We're going to get more stimulus. Why? Maybe because it's an election year and everybody wants to make us happy. So we're going to get more stimulus nevertheless. And maybe it's because we're still below the projections. Who knows why that is. But I think that the stock market's going up because it's saying, great, 1.9% previous GDP went up to 2%, 10 basis points? 10 basis points, and we're, popping the champagne corks. And we're still going to get more stimulus. So maybe that's the reason why stocks are going up. And maybe stocks are going up because it's they have a little bit of a hangover from yesterday's Mario Draghi rally, where, ECB president promised us more, that the ECB, European Central Bank, will do whatever is needed. Take a look at the 10-year U.S. bond yield up 3.48% to 148. Bonds are going down, stocks are going up, and the dollar's going up. This is actually, from what I recall, this is actually what the markets used to look like in a normal economy. In a normal economy, the numbers come in better than expected. It means stocks should think that's good news. And that probably means we're going to get higher interest rates. And that means higher interest rates means 10-year bond yields go up. And that probably means higher interest rates means the dollar's going to go up. This is actually the reaction of what we would used to consider a normal economy. The problem is we're not in a normal economy because you take a look at this. Here we go. Okay? Type in, I'll type it for you, I'll give you the link. USGG 10-year :IND. Okay. This is the charts for, and I'll project this in just a moment here. This is a chart, 5 years, and what's the symbol for the Dow Jones? Is it IND, INDU, or INDU? There we go. Okay. All right. So we take a look at the following chart. The red line is the U.S. 10-year bond yield. The green line is the Dow Jones Industrial Average. Here's a link, by the way, everybody, for the bond charts. If you want to overlay the stock chart, and when you add a comparison, you type in INDU :IND. Okay. Now, what does this tell us? This tells us, go back to 2008, 2009. Stocks went down, bond yields went down. Stocks go up, bond yields go up. But what happened when we started to get all of this quantitative easing? All this quantitative easing sent bond yields down. Remember, the purpose of quantitative easing is to keep long-term interest rates as low as possible. The unintended consequences is that it sends bond yields lower. As bond yields go lower, the 10-year bond yield obviously goes lower, and you get this divergence. This divergence is not normal. When stocks go up, we should see bond yields go up. When stocks go down, we should see bond yields go down. So although the immediate market reaction seems somewhat normal, there's something that has to change because it's not what we would expect it to be. Now, take a look at some of these questions. I don't want to miss anybody. Now, but Italy and Spain lurk in the shadows of trouble, not to mention France. It's very, very true. And also on the same notes, maybe a little spur in the euro is what sellers are waiting for on the sidelines looking for. Listen, I agree. I think long term, I don't think that there's any question where we're going in the euro. Not to rain on Mario Draghi's parade, but the fact of the matter is, the long-term chart to the downside, these are long-term fundamentals sending the euro dollar lower. Nothing has changed so far. Now, let's go to Europe for a second, then we're going to go back to the U.S. Let's say in Europe, Mario Draghi, President of ECB, says we're going to do whatever is necessary. And we'd like to hear that kind of talk. We love to hear that manipulation. I read your words, manipulation. We like to hear that rhetoric. What is it? I mean, they want to do whatever they can do. But what is it that they can do? They can buy long-term Spanish bonds. Okay, well, that's nice. That'll push yields down. What is that doing? That is throwing a glass of water on a forest fire. You have, okay, in Greece, roll back a couple years or so. Greece had a debt to GDP ratio of about 150%. For every euro or every dollar, however you want to say it, that is produced in GDP, the country spends $1.50 or €1.50 in their spending. Well, that's unsustainable. Eventually, it reached a point where investors in the bond market all of a sudden said, okay, hold on a second, stop the music. This has got to stop. Greece is spending a lot more than they're taking in. Those bonds don't look like such a safe investment. We demand a higher yield from the bond market. Greek bond yields start to go up. Well, as Greek bond yields go up, the interest rates that Greece has to pay to their investors to borrow money to pay off their debts, and they're borrowing more than than they're taking in. They're spending more than they're taking in. They have to pay more. Imagine that we lose our job and then our credit card rates all of a sudden double. And the next day we lose our house, and then we don't lose our house. Our mortgage goes up, and then our credit card interest rates go up again. And then we come into some unexpected expense, and then our credit card rates go up again. That's the bond market. The bond market is a very unforgiving mechanism. As the situation in Greece got worse and worse and worse, bond yields went up more and more and more because investors said, listen, if you want me to buy a Greek bond, you're really going to have to pay me to take on this risk. I see their balance sheet. I see their books. I see that it's not a good investment. I'm going to buy bonds in a country that has a debt-to-GDP ratio of below 100%, like Germany, for example, okay? So I'm going to sell my Greek bonds, and I'm going to buy my German bonds, and that's why German bond yields for the 10-year bonds are down. Where are they? 1.35%. Greek bond yields, GGG, 26%. German 10-year, these are all 10-year bonds. 10-year bonds yields, German bond yields right now 1.35%. Greece, we're talking GGG, 26.76%. The difference between the two, the German to Greece spread is, let's put too many E's in Greece, by the way, is the difference in what we expect, our expectations of, basically that they'll pay their investors back. U.S. 10-year bond, U.S. 10-year bond is 1.47%. Spain, right now, 6.71%, and that's down. Remember, it was 7.5% 2 days ago. Portugal is 11.34%. Okay, so you get the picture. France, not as good as Germany, but definitely better than most, 2.19%. The safer the country, the lower the yield, the more risky the investment, the higher the yields. Well, European Central Bank, let's say they go into the open market and they buy all the Spanish bonds in the world. And that sends the yields down. Basically, all it does is it buys Spain more time to pay back their investments and hopefully to fix their economy. But let's re-examine what's the reason why we have a debt-to-GDP ratio of 150% in Spain. What's the reason why? Let me find the link really quickly. I think it's Trading Economics. Debt GDP ratio. I think it's this one. This is a great website. One of these days I'll actually subscribe to it. Rank countries. Whoops, that's not it. Debt to GDP. I know I only have a few minutes left here, so I really don't want to get boggled down in this. If you Google Trading Economics, debt to GDP ratio, here, list by country. I think this is the link. Yes, it is. Here's the link. This does a very good job of illustrating who's in trouble and who isn't, or who's in more trouble than the other. Japan has a debt to GDP ratio of 211%. For every yen that's taken in the GDP, they're spending 211. The U.S. is 103, France is 85, UK 85, Canada 85, Germany 81. But take a look at the actual list. Japan's number one with 211. No big surprise. That's gone up. It was 150 a couple months ago. Italy at 120. Ireland at 108. Portugal 108 at 107. U.S. at 103. Where is Spain? There we go. Spain, 68.50%. I thought it was higher than that. There's a lot of different barometers that we use, so it's maybe not necessarily the debt to GDP ratio alone. But the fact of the matter is, the higher the debt to GDP ratio, the more we spend versus the more we take in, tends to have an adverse effect on the economy. Point being, European Central Bank, that can buy all the bonds in the world, but is that going to fix the debt to GDP ratio? Is that going to fix the spending habits of these different countries, including the U.S.? We're no one to preach in the U.S. because we happen to be probably number 5 on the list. But the fiscal cliff that we're talking about, the S&P downgrade last year, as a result of Congress not being able to decide whether to cut spending or raise taxes, or to do neither, or to raise taxes and raise spending. We're in no position in the U.S. to tell anybody else how to manage our debt, because we're certainly not in any positive position here. Now, 1.4% too low for economics and investment capital growth. Well, it's trying to incentivize. I mean, it's a great point, Jack. It's trying to incentivize consumers to get back into the stores. The Federal Reserve does not want you to keep your money in a savings account. It does not want you to keep your money hidden in bonds. It wants you to put your money to work, buy a house, buy a car, buy a refrigerator, extend your credit cards, invest in a company, start a new company, buy stocks, put your money into the economy. They really need us. The Federal Reserve can't fix the economy. We fix the economy. But as an individual, we're not going to go shopping unless we have some sort of confidence that we're going to have a job tomorrow and that our house price is not going to fall further. U.S. new home sales 2 days ago declined 8% in the Northeast. Boston, New York, Washington corridor, 60% drop in 1 month. That does not exude a lot of confidence for those people in the stores. Is any Euro country going to let another go bankrupt? I don't really think that's a serious possibility. It hurts too many other countries. Countries are too big of a problem to let fail. That is the question that everyone's trying to answer. I mean, if that's the case, what does that imply for Germany? Greece needs to have a little chat with Iceland. Also, Greece probably will leave the currency but can stay in the Eurozone. It's funny, I heard on Bloomberg the other day, they're actually talking about the new phenomenon in the market is this. The countries, okay, we have Euro area countries. Those are 27 countries. You have Eurozone countries that use the actual Euro currency. Italy, Spain, Portugal, Ireland, etc. Now, or maybe not Ireland, I don't know. Spain, Italy, Portugal, Germany, France, etc. The countries in the Euro area that do not use the Euro currency are actually experiencing a greater amount of confidence that the investors are moving their money into countries that are in the Euro area that do not use a Euro currency. How amazing is that? Germany, by the way, Germany can't carry such a huge burden. But think about it this way. Germany is an export-driven economy. Every time the Euro currency goes down, it's a double-edged sword with Germany, but they're not exactly on the losing end, the short stick, as you said, of 100%. As the euro goes down, Germany's exports, all those BMWs and Mercedes and all their other, and they are an export-driven economy. Those exports become a lot cheaper for everybody else. Well, as a result, Germany does not mind a weak euro, but Germany wants a weak euro with strong euro area customers. They want people in Spain and Italy and England, well, not England, but other euro area countries, they want those individuals to have jobs so they have money so they can buy BMWs and they can buy Mercedes. China, we didn't even talk about, is an unbelievably important factor as well. So Germany says, great, the euro coming down, that makes our exports cheaper. But, we want the euro to come down, ideally, as the economy is improving. Euros into krones, into Swissies. What's the currency in the Czech Republic? I was there and I forget krone? No, that's Norway. Anyway, I would not necessarily say Swissy because the Swiss National Bank has intervened on their currency so much it's basically locked. Now they're preventing it from rallying too much. But yeah, and it's something that has already occurred. This is not a new trade. Capital is moving out of the euro into other euro area currencies. Getting back to the U.S. again, U.S. GDP, and of course we're all connected. What's good for Europe is good for us and vice versa. U.S. GDP 1.5% last month was revised up to 2.0%. If you look at the FX Street calendar, the number is green, which means we beat expectations. But beating expectations is not necessarily, we beat expectations, but we're not out of the woods. 1.5% GDP is nothing to celebrate. And that probably means that the chances of quantitative easing increase in our favor. But we'll have to see. The next big numbers, of course, the Federal Reserve is meeting, and then we also have non-farm payrolls and the PC figures, CPI inflationary numbers as well. All of those numbers are very important. All of this news, all of this data, probably threw too much at you, just goes together to give us a better idea about what is most likely. Ultimately, we're trying to answer the question, what is the Federal Reserve most likely to do? What is the European Central Bank most likely to do? And from that, we can anticipate which way the currency is most likely to do, and then we can design a trade idea, whether it's a short-term day trade or a long-term swing trade or position trade. We can design our trade to always be on the same side as the strength of the fundamentals. Fortunately, I'm out of time. If you want to contact me, you can do so directly, www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more ahead of us. Great day, all profitable trades. And we look forward to seeing you back soon, back inside FX Streets.